So some key developments on my mind, right? Pre-tariff data. Some economists argue that the data that wasn't including the tariff, right? All the data was kind of not affected from these tariffs. That is all old news now, and so all the news kind of moving forward is going to represent what it would look like if the tariffs were in place. Damn, I keep getting these emails. Okay, so key developments on my mind. I'm going to go over again. Key developments on my mind. A lot of economists argue that the previous data up until now was not reflective of the tariffs were in place. And so what I mean by that is, like, moving forward, we'll get a good gauge as to how the economy is reacting or going to be with these new tariff measures in place. And so now I feel like the data is going to be data, because I remember specifically a couple CPI prints ago, you get a high CPI print, the dollar would not move like it should have, like a traditional thing. And that's another thing I wanted to say, is that these traditional correlations were not really in effect, right? Usually dollar up, stocks down, or vice versa, stocks up, dollar down, and a lot of other correlations, right? But that's the main one everyone knows. Those were not in place, right? The Trump trade, right? The dollar was appreciating a lot along with the stock market because of deregulation and all the stuff for the equities. And now, it was with the whole tariff 50%, everything, it was stocks down, dollar down. And so now I feel like the correlations are starting to rebalance out as well. And another thing that I'm going to start looking closely, now that we can kind of anticipate that data is going to be data, and the data is going to kind of be a traditional move, whereas if a data comes out the dollar will react in a certain way, kind of traditionally, is I want to watch the Fed closely, right? So I want to look at the CME Fed Watch, who I want to listen to the narrative or their tone when they're having their Fed meetings, to kind of see if the Fed is comfortable enough to start lowering their rates. For the most part, everyone has started lowering the rates, with the exception of for the exception of Japan raising their rates. But for the most part, the dollar is behind the curve in that respect. And so I want to watch the Fed closely to kind of get a gauge and see if it is going to be time for some dollar depreciation or not. And also, just fundamental principle that I always look at whenever I'm going into a trade or considering a trade is tracking global economic health, right? The heat maps that we have access to is a great tool for that respect, right? For that task, is to get a gauge as to what's hot, what's not, what's getting better, what's getting worse. And so I want to make sure that I'm continuing to look at those variables to make sure that I'm trading the right pairs. Another thing that's on my mind is the tariff deadline is approaching, right? We really haven't had any solidified deals. Now there's a lot of talks happening, but no deals, kind of solidified. So I want to be mindful of that. Perhaps that's another news flow catalyst that we can expect to cause more volatility. This year has been the year of volatility for my personal experience, right? Safe haven demand on standby. So this PowerPoint that I made was a couple of days ago, but now we have this new Israel-Iran situation that just came up. That was another trigger for safe haven demand. Now that was short-lived. It seems like people are on the ball as far as controlling that tension. And this is not the first time that this has happened. So this is another reason why it was short-lived. But always be mindful of the indicators that we have access to. I always say this: the VIX, the put to call, sentiment. You want to make sure you're looking at that to get a gauge and see if we're going to have another one of those shifts from risk on to risk off. And the Japanese bond market, right? There's a blind spot that growing risk of global investors are underestimated. Man, why do I keep getting these messages? Okay, I'm going to go over that again. For the Japanese bond market, right, you have that blind spot, this ultra loose monetary policy, and a lot of the Japanese institutions are one of the biggest holders of their bonds, right? So that's another kind of thing we have to look at. If there is a disruption in the Japanese bond market, that could cause a rippling effect in all markets, right? If we all remember what happened with Japan, the July-August sell-off, right? We had that intervention, and then we had the interest rate hike in Japan that caused a big deleveraging event, and that trickled into everything, right? I remember everything being in the red for some time, and so we need to keep in mind on that one as well. So advice for myself, and then for anyone watching, traders that are going to be considering the continuing trading in the market, widen your stops, right? Your stop needs to be where the stop needs to be. That's the non-negotiable. Lower your risk. That way you can, I'm gonna say that again. Lower the risk. That way you can account for the whipsaws, for all the noise that you're going to experience. And then also with these increased volatility, the increased ATRs, shorten your trade time horizon, right? No longer am I able to sit in a swing position and hold it and expect to hold it for 3 days to a week or two. That's going to change, right? If the volatility and the ranges are going to be widened, then most likely than not, your stop loss or your take profit is going to be hitting in a shorter amount of time. And for investors, look, if you're going to be in this thing for the long run, if you are an investor, right, you're not trading the markets, but you're just concerned about your overall investments and things like that, sit through the noise. If your time horizon is more than 5 years, you're going to be fine. Continue investing. If there's a dip, which is probably going to happen, buy into it. Don't over leverage. You're going to be fine, right? You're going to be doing well in the long run. And if you have the opportunity, or you're getting new into investing, the traditional 60-40 portfolio, with 60 being equities and the other 40 being bonds traditionally are a hedge to overall market risk, right? Volatility risk. Perhaps gold or Bitcoin is a better hedge. It's been proven. Right now, the bond market is a tricky situation to navigate, and gold and Bitcoin are outperforming. They're outperforming equities right now in this time of risk aversion. So I would suggest that, something I'm doing myself, and you're gonna be okay, right? Trade safely, trade to trade another day. Your execution, your decision making today, make sure that you're considering tomorrow. That way you're not getting taken out of the market, and you can't afford to trade another day, right? But regardless, you guys are in great hands. Thank you guys for tuning into this portion of the webinar. I appreciate you guys. Have a blessed one. Bye-bye.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.